Hey everyone, Anthony Venuti here with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, I want to talk about a few ways to protect yourself with rising interest rates and what you should consider even if you have a fixed rate mortgage. So stay tuned, we're going to dive right in. Once again, I want to take this opportunity to continuously thank all our supporters and viewers of the channel, everyone taking the time out of their day to comment, leave a DM, to send us an email about suggestions and future topics, even questions that they may have about their mortgage. We appreciate everyone's time and feedback, and we do our best to try to answer all those questions as we continue our financial literacy journey to continue to educate Canadians when it comes to real estate and mortgages and everything in between. So on this episode, I do want to talk a little bit about what is happening in the Bank of Canada, as well as the Central Bank of the US, as well as things that you should be considering on how to protect yourself as interest rates are on the rise. So first and foremost, we may all be aware right now that the central banks, both the US and the Canadian central banks, have indicated to all of us that they are on the path to rising interest rates. And that is because they're trying to tackle inflation and try to bring their target range back down to 2% inflation. And here in Canada, we're sitting at 5.7%, highest it's been in 30 years. And when we start to hear these sentiments, we start to prepare our clients for higher interest rates and what is to come in the near future. So obviously, all these central bank decisions are important topics globally. We have to look at everything geopolitically, everything that's happening in the world. But how does it impact your mortgage? That is the major question. So I want to start off with the actual illustration, a case study for a client that called us about a week and a half ago, and we were talking with them about looking at locking into a fixed rate mortgage. So they had basically purchased a home about a year and a half ago. So they have about 3.5 years left on their mortgage. We advised them, please reach out to your bank, call them, the lender, and see exactly where you are and what they're willing to offer you for the remaining 3 years and where you are on that rate. So once they contacted us, we had the numbers, we started running the options and saying, look, here's where you are on your variable rate mortgage. Here's where it is on the fixed for the remaining term. And it was about a $300 discrepancy per month. And we basically did some math and we said, look, this is what it's going to cost you. But more importantly, we had a conversation about, them being in a condo. They had just got married and where their goals are and what their aspirations are. And they had basically advised us that they're expecting their first child and that their 1-bedroom condo is actually not going to be, sufficient enough for them to raise their child. And this led us to another conversation about what they plan to do, because the origination of the call was just about the fixed and the variable to how to save some money. And it ended up being how we can save them thousands of dollars down the road. So once we'd had this conversation, we looked at it and said, look, if you're going to lock into the fixed rate mortgage, this could be the potential penalty that you'll pay if you have to sell this condo anytime soon, unless you can ride out the remaining term. And they advised us, say, look, Anthony, I don't think we can make it that long. We're actually thinking about it. The seed was already planted. So I said to them, maybe right now is going to be a better option for you to stay variable because of the particular situation that you're looking to either move in with some family if you can sell the place and then go out there and buy a place, or they were actually going in the process of purchasing a pre-construction or a new build that wasn't going to close for about a year and a half. And then we talked about delays and all this other stuff. And then they said, you know what, Anthony, I think you're right. I think we're going to stay variable because the cost of the penalty was going to be far greater than the difference that the potential could have been with the increases to the policy rate over the next few years. So that is an interesting conversation that we had with a client. And just to sort of get down to the root and not say, like, don't walk over the dollars to pick up the cents, because basically they were going to leave some money on the table if they would have locked into a fixed rate mortgage in this particular scenario. So now let's talk in generalities. Let's move over to, you as the consumer, if you have a fixed rate or variable rate mortgage. Now I'll start off with the fixed and say, look, if you're in a fixed rate mortgage, you have pretty much nothing to fear, nothing to worry about, as you are locked in for the entire duration or the term of that mortgage. However, this is where the caveat comes in, is depending on when that mortgage will mature, and depending if it's 1 year, 6 months, 2 years from now, based on what's happening right now in the mortgage marketplace, you do need to take into consideration that you might be paying a higher interest rate than what you had originally had on your mortgage. So that is an important aspect, and to help you budget for that, to say, look, if the difference is going to be a couple $100 a month and we're going to be running out of runway soon, how do we better protect ourselves for that potential new mortgage. Now, obviously, anything can change between now and the time of that mortgage coming up for maturity, but it's always good to plan ahead, especially now that you got your mortgage statements not too long ago. Take a quick look at it, see if now's the opportunity or now you have a time to maybe pay off some of those debts. And that brings us into the variable rate mortgage because it's more susceptible to change and it's more volatile to the Bank of Canada policy rate changes, prime lending rate changes by your lender. That could mean, you're a little bit more exposed when interest rates change. So how do you combat that? How do you protect yourself against those changes? Well, obviously, the first thing you can do is to protect yourself is, if you choose, lock into a fixed rate mortgage. But that could mean you're paying $200-$300, maybe up towards $800 to $1,000 more on your mortgage per month based on where interest rates are today. The other thing that we always tell our clients is if you have some surplus funds laying around or you have some ability to pay off some of your higher interest card debts, that's going to free up some money that you can put aside that when interest rates go up, you're actually able to comfortably pay for those increases. So obviously absolving yourself of any other external debt is going to leave more money on the table. The other thing we talked about with clients that may have a line of credit or home equity line of credit, there is a distinction between a secured and unsecured. So if you have a line of credit with a substantial balance on it, you can either talk to your institution about locking that into a fixed rate component or into a variable rate component so that you can basically make those payments very static. The other option is that you can look at what is happening and saying, look, if I was to pay off my line of credit and some other debts and maybe absolve myself of some car payments, whatever the case may be for your particular scenario, is restructure everything into one simplified payment so that you actually are able to budget more efficiently. So that is another suggestion that we have with clients. Now, let's say, for example, you're not in a situation where you have any debt or you have no lines of credit. What can you do to protect yourself better in a variable rate mortgage against rising interest rates? One thing you can actually do is actually start to put prepayments towards your mortgage, increase those payments if possible, and also put some lump sum money towards your mortgage, as that will go directly to principal and bypass interest. So that is a very important element to helping you protect yourself against rising interest rates, because as interest rates go up and your mortgage payments will change, so will the interest calculations on the back end of the mortgage. And by increasing the frequency of your payments, maybe even going from monthly to biweekly to weekly, can also help trigger more money going towards principal than towards interest. So that's another valuable add-on. The last little piece of advice that I can give to any mortgage holder and homeowner is preparing a balanced budget. It is very important to know exactly how much money is coming in and how much money is going out and where you can cut costs. So a lot of times we'll be talking with clients when they're purchasing a home or they're trying to get a pre-approval and you're looking at their expenditures. And I always say to clients, there are things that you can, reduce your expenditures on, cut back on. I know we're in a subscription-based society and a lot of things are, getting a little bit more expensive. Is there things that you can do to cut back and actually keep some more money in your pocket? Because that alone, by budgeting accordingly and, changing some of your spending habits, can actually help keep more money in your pocket, which in turn, as I said, if you're in a variable rate mortgage and you see the value of being in a variable rate mortgage for the long haul, you can start to hedge and bet a little bit more against that increase by changing your lifestyle a little bit. Now, obviously, budgeting is not for everyone, but we do obviously suggest to all our clients, whether you're a first-time home buyer or an existing homeowner, is to prepare a budget, know exactly what's coming in, know exactly what's going out, so that you can help prepare yourself for any potential changes in the future. So I'm going to leave the video here. I hope everyone had a great experience. I hope you learned something here. Maybe if you did, if you didn't, let me know if there was something that I missed. Leave it in the comments below, please. We always love to hear our clients' feedbacks. But as I mentioned, I'm going to leave the video here and wish everyone a great Friday and an even better weekend ahead. Until next time, thanks for tuning in.